Hello, everybody. Welcome to Friday. We didn't have a Talk Money with Tom show today, but I did want to do a summary. I thought this was a fairly important week. There are quite a few things that happened as far as that goes. The week was down just a couple percent, actually. Looks like the market's kind of waiting around. Most of that down movement was because the Federal Reserve chairman was speaking at a conference in Chicago and just talking about how they really weren't going to step in and try to kind of save this because they don't know which direction things are going to go. Uh, Chairman Powell was actually more direct than usual. Usually they kind of speak, you got to figure out what they're talking about. But he was pretty clear that he felt like the tariffs were going to be inflationary, that they didn't know what tariffs we were going to have, how long they were going to have them. And so it's very difficult to decide on what direction to go with rates. And so, the market kind of fell down on that. It really, most of that 2% came off of those comments this week. You can see what they're talking about. You've got a scenario where they're in charge of trying to keep unemployment at, 4%, or better, which it's right now right there as it is. And they're trying to keep, core PCE inflation at 2%. And so, right now we're at about 2.8%. And what we're looking for there is, of course, you would lower rates to stimulate the job market and bring, unemployment back down to 4% if it gets higher. But if you do that, you could get inflationary pressures. And so, of course, if tariffs are out there, you already got inflationary pressures. Then maybe they raise rates. Of course, that destroys the job market. So that's the pickle that the Fed finds themselves in right now because of these tariffs. So that was the big battle this week. Really, we did hear some different things about kind of negotiations that are happening. It's a little vague. It's hard to tell what's going on, but it seems like we're closer to having conversations with China, just from the myriad of different articles that I've read. And my opinion, we have to solve the China situation here in the next 3 to 6 weeks, because we have too many businesses that are going to go out of business once they run out of inventory that rely upon imports from China to make their business work, especially small businesses. So, and today, Trump said that China had been calling him and talking to him kind of all along since the reciprocal tariffs, and that he thought there would be something in place within about 3 weeks. So that would be great. Actually, I think the market would respond quite positively to that. China does have some pretty good cards to play here. They have $800 billion worth of American debt. It was our market, bond market, that fell, not the rest of the world's bond markets. It was ours. And you got a lot of different countries that can sell our bonds and create all kinds of problems. Got different hedge funds doing things too. So that was the real reason I think that they backed off on the tariffs and did this 90-day pause a couple of weeks ago. However, they have China has another really powerful weapon. I don't think this is being talked about enough. It's been out there for quite a while. It's called rare earth metals. And so rare earth metals are, the types of metals that are, used in the production of really important things. They make magnets out of them. So, like electric vehicles, their motors use those, computer hard drives, speakers, headphones, that kind of stuff. You got different things like flat panel displays. The batteries that go into EVs and electric vehicles use rare earth metals, catalytic converters. You keep going as camera lenses, got, LED lights, fluorescent lights, you name it, even things to do with the MRI, contrasting agents and PET scan detectors, and et cetera. So these are super important. China controls 60 to 70% of the mining and production of the world's supply of rare earth metals. Worse, they control 85 to 92% of the actual refining and processing to turn it into something that we can use. And so they this week said that they were going to stop shipping rare earth metals to the US. And so that's a pretty powerful piece. And it's interesting here, we are the world's largest, consumer, but we do like to consume, and some of these businesses need to consume from China. And sometimes the ability to buy is actually more important than the ability to sell into our country. And so I think that's where we're going to end up, having some type of an agreement sooner than later. And then we'll have to see what that agreement is and what happens, because one of the things that we mentioned this week was that, a 2.2% was the average, net tariff of products coming into the US prior to Inauguration Day. And it's now 24 to 27%, depending on, who you listen to and which article you're reading at the time. But still significantly higher, essentially 10 times higher. Well, a lot of that's because China's at 145% now. So we get China back down to something reasonable. We can drop that average down. However, we still do have a blanket 10% across the world for everything. And really, when there's some pieces, sorry, that are carved out here and there for different reasons, but for the most part, most things. Nonetheless, even that's almost more than 4 times higher than what we had prior to Inauguration Day. So, we'll have to see what happens. So then, this week I was talking about on Wednesday, especially, what do we do with the money from the tariffs? Because one thing to have these tariffs and to create this inflationary pressure, it's another thing to have it come back into the economy. And, maybe that would be a thing that would help and make it work. There hasn't been a lot of talk. I know Peter Navarro was talking about, offsetting taxes, which sounds great, except it's very difficult to do because right now, if you want to pass a tax package, you either have to get, the majority and 60 votes in the Senate to get that passed, which is not going to happen. So they use this thing called a reconciliation. Reconciliation means that if I have $4.5 trillion worth of tax cuts, I have to make that up someplace. I have to have some spending cuts. I could have other revenues. Well, theoretically, tariffs are another revenue source. Maybe not super reliable, can go up and down, but and hard to predict what that would be over a 10-year period. However, they can't use tariffs that are put into place by the president in the reconciliation process. So they can't actually use that to match up against these tax cuts. It was pointed out to me, I mentioned that on Wednesday, that the Congress could pass the tariffs themselves, basically go through and just approve the tariffs that are out there when it finally gets stabilized to a point. And then that can actually be used in the reconciliation process. So that would take a simple majority to pass those tariffs. I don't know if there's a lot of interest in doing that and people putting their name on those tariffs, especially for, House members that are in sensitive districts. But that is a way that it could be done. I haven't heard anything about that so far. So I'm not sure what they're going to do with the tariff money and how that money is going to actually come back into the economy, if it's going to come back at all. Theoretically, it could be used, to pay down deficit, which would seem like a smart thing, but we'd probably end up in a recession doing that. Maybe that's what we need to get our debt down, and so be it. It'd be nice to know, what's happening. Because this week we had what's called the death cross, which is where the 50-day moving average from the S&P 500 crosses down through the 200-day moving average. And so this is a fairly heavily watched, situation. It's, in the past, you would kind of sell theoretically when that happens, and you would buy when the 50-day comes up from the bottom up through the 200-day moving average, which is they call the golden cross. And if you look back at the 2008 downturn, if you did that, you would have missed out on 38% of that 57% downturn. So you would have had some loss here and gotten maybe not right back in the bottom, but you would have done really, really well. So it's very powerful in that regards. However, if you look at 2022 and this 28% drop, you've only saved about 1.3% by selling out at the cross and coming back in. And worse, actually, if you look at the tariff scenario that happened in 2018, when the market dropped 19.6%, you would have actually lost 6%. You would have been better off just staying in. And that's the problem we're having right now. And I've been saying this several times. This is a manufactured crisis at this point in time. It is not a structural issue. We do not have, a scenario like we had in 2008. We could be heading there. And I think that if we keep these tariffs too long on China, we could get there sooner than later, personally. I also feel like there's some room there to be able to negotiate that down before things get really out of control. I would say it's likely that growth won't be what it could have been without all of these things, just because, again, the uncertainty has created an environment where CEOs and consumers are worried about, what they should do. We're seeing, travel fall off quite a bit, those types of things already. So, we'll see how that plays out. We did have retail sales come out. They were really high for the month of March, 1.4%. That's super high. And so you might look at that and say, wow, the economy's doing really well. Probably what's happening is everybody's running out trying to buy stuff that they think is going to go up in cost. I heard, Apple stores were crowded and, lots of clients talking about buying automobiles, before the tariffs hit, those types of things. So that's, probably an artificial number. We'll probably see once these tariffs do really hit, uh, even less sales than we might have, just because people have, pre-purchased essentially different things as far as that goes. So, looking at where we're at the moment, as I mentioned, our average, across all of our clientele was 63% stock, and the rest was in bonds and money market and such. We're down to 33% now. And we we dropped down to 23 and then back up to 33 based on that 90-day pause. So our average client across the board has about half the money that they would normally have in the market. It's a little bit skewed because part of what we didn't sell was these highly appreciated assets. We have some clients that have more than half and a lot of clients that have less, but nonetheless, it's not a bad place to be, in my opinion, right now, just because there's a lot of uncertainty, but it can go either way. I would say if there was some pretty good, conversations going on with China, the market's going to start to move. If they announce something, much more reasonable, the market's going to move pretty heavily. If we can incorporate some of these rare earth metals, into that conversation, because it's a really big deal. It's not being talked about enough. We're going to have issues with all of these areas if we can't get our hands on them. As a matter of fact, if you remember, the negotiations that were going on with Ukraine had to do with mineral rights, and most of those were rare earth minerals. Ukraine has some. And so, again, this is a realization that if you're going to try to wall off China and do all these things to China, if they pull that production, you got to have someplace to go. Again, this isn't something you can just do overnight. So that's where there's a lot of gaps in timing. Yes, maybe industry can start to move back to the U.S., but not overnight. Maybe we can find places to get rare earth metals, but again, not overnight. And so in that gap period, you could have some real problems, and that's where you want to be. Maybe half of your exposure in the market, just because things could fall apart. But on the other hand, things could turn around really fast tomorrow, next week, the week after that. So again, as long as this is a manufactured crisis, I would still keep some money in the market. That's for sure. Can make an argument for having more, for that matter. But once this starts to turn into, a more structural crisis, kind of like what we had in 2008, when things start to fall and, different things along those lines, then, you'd probably want to be even less exposed, just because that's going to take quite a bit of time to come back. So anyway, that's where we're at the moment. It is interesting. There's some hope. There's some things that are, a bit more on the negative side too. I mean, both of those things developed this week. And altogether, the market ended up a couple percent down. So, there's a lot that's happened here. However, we're only about 12% down off of the high from the, back in February. That happens regularly. The only reason that this is getting talked about so much is because of all the context of why we're down. And then really kind of the thought process of what could be happening later. If these tariffs turn into something that really does create problems. We are much more so a service, society than we ever have been. These tariffs predominantly are affecting goods. They would affect everything in the end because, if inflation goes up, you end up having to pay people more, and even services get more expensive. We saw that for ourselves and our own business here, at Retirement Capital Strategies during the last inflationary spike. So it can have an impact all the way across, but we don't know for sure what these tariffs are going to be, how long they're going to hang in there, what type of impact they're going to actually have on consumers. And so that's what we're kind of waiting to see, as far as that goes. So Anyway, that's what's happening this week. It was an interesting week to be paying attention. Look forward to, again, see you on Monday when we do the next little video here on what's happening to the market then. Enjoy your Easter, and thank you very much.